Oh, wow, you got me, caught me whistling there. Song never, ever, ever gets old. Happy Friday, guys. We made it. We made it. We made it. We made it. All right. What's the market doing today? Boy, can't keep a market down, I guess. S&Ps are up 40 points. Why? I don't know. Maybe it's the talk of Russia and Ukraine possibly coming to the table. Could be that. But doesn't make a lot of sense to me, but doesn't have to make sense to me. The market knows more than I do than anyone does, but I just know that I would think it's time to buy a little downside protection, not necessarily because there's going to be a sell-off, but just because we can and not because we have to. All right. Sorry about that. Please like, subscribe, smash, all that good stuff, everybody. Today we are going to do a rapid fire. What does that mean for all you first timers or people that have not been here before in rapid fire? It means I am going to take questions on the fly from you, whether it's about a strategy, whether it is about a particular setup, whether it is a position you have that you want to review. Nothing's off limits. Absolutely nothing is off limits. So today is a learn as we go. One thing I do want to talk about briefly, because I had a few students ask me this morning about exercise and assignment. So I want to put up a position here real quickly. Hang with me. And I'm just going to put up an example position here. Here we go. Okay. If this was your position, hello, David. If this was your position, expiring today, okay, Palo Alto's trading about 167. What would the process be for both of these put options? What would happen? Anybody? Okay, this is short the 190 put and long the 180 put. Okay, Victor says they will offset, and they will. Okay, is there risk? Hey, Kevin, is there risk for assignment on the short put option here? Okay, Bill says auto assigned and then exercised. Excellent. Not expire worthless, Rocky. These are puts, not calls, and the stock is 167. Thank you, Kevin, as always. And while you're thinking about this, folks, start putting some questions in here, what you would like to ask, review today. Okay, you won't take a $1,000 hit. Well, I guess the spread would be worth 10 less the credit. Okay, so that's the P&L on this. But what about your position? Dave, that's a great one. We'll talk about that next. Does everybody know how the process works? If we were at the end of the day today, okay, this was the position, this is the stock. Here is what would happen. For those of you that have never experienced an expiration day position where both options were in the money, okay, no pin risk, David, because the stock's all the way down at 167. So pin risk is when we're right near one of the strikes. So the way that exercise and assignment works on expiration is your clearing firm, your brokerage firm. They will assign to you your short option first. Okay, what does that mean? That means, let's say we end the day today and you're assuming that this position is going to offset one another and it's worth $10. That is all true. That is all true. However, the way the process works is when you look at your positions tomorrow morning, yes, tomorrow is Saturday. When you look at your positions tomorrow morning, you will only see the assigned position, meaning you're going to see stock at 190 in your position. Okay, if you had 5 of these, you'll see 500 shares. If it's 100 shares. You will only see the long stock from the assignment. You will not see the exercise happening. You will not see the offsetting short stock at 180. But when we get to Monday, your position will be gone. It will have offset. If you have never experienced this before, okay, it is a heads up. We always talk about it. If we get into this kind of situation, we always talk about it. We always give a heads up because, again, if you haven't been through this, you're going to look at your position tomorrow morning and say, oh my God, Scott told me these were going to offset one another. I only see that I got assigned. I'm going after him. Okay, but with 100% certainty, they will offset. Does everybody understand that? Does everybody understand that? Absolutely, Kevin. Awesome. And listen, I can talk till I'm blue in the face, right? Until you actually experience it firsthand and see it in action, okay? Probably not going to mean a heck of a lot to you. But that is a biggie. That is a biggie. Okay, David, when you were asking about pin risk, were you talking about specific to that position I just had up or just in general? Both. Okay. Pin risk, and I'm just looking at something here that Charlie just said. Hang on. Before we go into pin risk here, guys, I just want to put this up here. Charlie said just now that this stock SBET Sharp Link Gaming is on watch. I think that's because of a break here of the 50-day to the upside. I'm asking him right now. They do have earnings next week. So you know what? Let's go back to pin risk for a second, and then we're going to go through SBET here. We get a little more intel from Charlie, and then we're going to go through SBET. But here is what happens with pin risk. Can everybody see the Word document that I put up here? Okay, Hasnain, and if I mispronounce your name, I apologize. What is wrong? You said something was wrong. Can you let me know, please? So pin risk, okay, the word pin means risk if the stock closes at expiration at or near a strike that you are long or short. Okay? Because this is what the risk is. We know that every this is the rule, this is the law. Every brokerage firm is going to exercise at expiration any option that is a penny or more in the money. Okay? Those options will be automatically exercised. So options that are a penny or more in the money at expiration will automatically be exercised. Okay, does everybody understand that? Does everybody, anybody ever experience that? Okay, and Hasnain, are you here? Okay, so this is the rule. Now, that doesn't mean that you or somebody else can't not exercise. Okay? Can everybody still hear me? I want to make sure we are still connected here. I just got some error message. Okay, great. Great. So remember, owning an option gives you a right. Okay? Selling an option gives you, or you have obligations. You always have the right to exercise your option or not. Even if your option is out of the money and you own it, you can still exercise it. Or in this case here, let's say, and I'm just going to throw out an example here. Let's say you are short a 75 call and the stock closes 75.02. Okay? Excuse me. Wrong way. And the stock closes 74.98. Okay? You're going to be at the end of the day on Friday expiration, and you're going to say, I skated, right? That call is worthless. And theoretically, it is worthless. It absolutely is worthless. However, if the owner of that call, for whatever reason, wants to exercise it, because maybe they think that the stock is going to gap open or it's going to open on Monday, or maybe there's some sort of announcement after the close on Friday while the market is still open and for trading after the close, the person who owns that call can always exercise that up until 1 hour after the close of the market on Friday expiration. This would be pin risk. You're pinned. From my experience, and I have experienced this hundreds of times in my career, both trading on the floor, trading on the screens. If I have a short option, which is within a few pennies or so of the strike at expiration, what do you think I'm going to do? What do you think I'm going to do? I am going to close it out. I'll pay a penny. Maybe I have to pay 2 cents, right? And you're going to say, well, I don't want to pay a penny. I don't want to pay 2 cents because it's worthless. And again, theoretically, it is worthless. But you don't know the scenario where the other person who owns that option, for whatever reason, may exercise it. And then all of a sudden you'd be short stock. Not sell it, Brad. We'd be buying it. We're short that option. So that is what's known as pin risk. Okay? Does everybody understand that? Anybody have any questions? And there you go, Bill. Exactly. So somebody that owned that 150 strike call, they didn't want the stock. So they didn't exercise it. So as Bill just said, the opposite can hold true. Let's say you own that call. You own the 75 call. Okay? So you own the 75 call and stock closes 75.03. Okay, you're thinking, great, it's automatically going to be exercised. I'm going to get my long stock at 75. For whatever reason, if you don't want that stock, you don't want to have a stock position. Okay, you can obviously either close that option out while the market is open, or you can direct your brokerage firm not to exercise that option. That is called an options exception notice. Because if you don't say anything to them, they're automatically going to exercise it because it's a penny or more in the money. You can instruct them not to exercise it. Stephen, if it was 73.98, it depends on the dynamic of the market. Let's say the stock shot up $5 that day to close at 73.98, has a lot of momentum behind it. I'm probably going to close my option for a penny and not run that risk. Because remember, the stock is still going to trade for an hour or so after the market closes. So if the stock rallies after the market closes half an hour afterwards, you think that you have this short option that is worthless, but all of a sudden the stock goes up after the market closes. Well, the person that owns that option may exercise it. Okay? Everybody understand that? Okay. Another question here from Dave. In a strangle swap, I know the goal is to have the underlying move to one of the shorts. If the underlying price stays in the middle, do the two strikes tend to cancel each other out? Okay, so strangle swap. Ideally, we want the stock to move to a short strike at expiration. Okay, that would be ideal because then the options we've sold are going to be worthless or as close to worthless as possible, while hopefully the options that we own have held their value or even increased in value a little bit. If the stock just stays right in the middle, this is bad for our position. Because yes, the shorts are going to expire worthless, but our longs are also going to lose a ton of value. Does that help out? Does that answer your question? Okay, before we move on, and before we even get to the word of the day, we're going to do a little quiz here. Okay? We're going to do a little quiz. Now, we're all on the honor system. You obviously can use Google, ChatGPT, but it's going to be the first one to answer correctly. What is so special in Major League Baseball that happened 37 years ago today? David, I would only try and close it if I'm just, going to take my loss and move on. I still have my long options to hold on to in case something happens. Okay, nope, 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 nope. Not the right answers yet. Nope, nope, nope. This is good. That means you guys are on the honor system because I would have expected somebody could have just kind of Googled that. I wish the Cubs would have won. It does have something to do with the Cubs. Gus, what's that? Gus could be on to something. Come on, everybody. 8888. Okay. It was the first scheduled Cubs night game. It actually got rained out. And they played the next day. 8888 was the first scheduled night game at Wrigley Field when they first installed lights. Okay, I'm not going to say, oh, just because you said that was the first night game and it really wasn't because they didn't play, that's still the right answer. That is still the right answer. So, Gus, that's probably what you meant, but I'm assuming that's good. Mark, you were the first one that actually had the full right answer. So both of you will be in on that. Okay? All right. So Michael Clark, if you could put that on our list here and let us know, that would be great. Now, let's get to our wheel of the day here. Thor says it is TGIF. It is TGIF. You guys, I'll have to remember that 8888 because I can guarantee you with 100% certainty that next year on August 8th, I'll be asking the same thing. All right, everybody, give you another minute or so here to get the TGIFs in, and then we're going to go back to teaching and learning and discussing. I'm going to go back here and see what other questions were up here before I distracted everybody with Cubs historical happenings. And I don't really see any other questions here yet. So bring it on, folks. Bring it on. Bring it on. Charlie's telling me massive put seller at the 220 strike in Apple for February. And going back to that S bet, let's go through that, folks. Let's go through that. Okay, let's look one more time. Here's the chart. Okay, here's the chart. Charlie's saying there is a lot of volume and a lot of momentum in here. So let's just say, for instance, we want to take a long delta position, which is into earnings for next week. Okay, here's volatility. Doesn't look all that bad. $813 is the estimated earnings. Well, let's see if the options actually reflect that. Okay, with stock 24 and a half, next week's implied at the money vol is about 175. The following week, yeah, it's not that different. Maybe earnings aren't going to be next week. The vol curve is really, really flat. It is really flat. Any hope for TTD stock? Well, I had my eye on it last night and this morning because there was a big gap that it filled, but then it just kept going right through it. So that stock looks a little troubled at this point. All right, so I just chose this expiration August 29th randomly here. If I look here, we've got an expected move right around $8 or so. Okay, so we could target, let's say 32, 33, somewhere right in that area. Let's just see if a simple call spread. Yeah, really, really, really cheap call spreads. You know why? How come call spreads are really cheap here? What do you notice about the strikes? Let's say from at the money, the 24, 25 strike to, let's say, up to the 30 strike. What do you notice? There's a ton of extrinsic. There's a ton of extrinsic value. But what do you notice in the difference between those strikes? Yeah, look at the implied volatility. Good one, Brad. Look at the call skew. So, for instance, here's the at the money 162 vol. Doesn't matter whether that is cheap, expensive, in the middle. But then even look at the 30 strike. And then the 35 strike. Massive skew to the upside. Massive skew to the upside, meaning that the further out of the money calls are much cheaper, much more expensive. The at the monies, in the monies, much cheaper. Love situations like this. If you're bullish in a situation like this and there is a massive call skew, sign me up. In fact, we may look at something right here and then put a position out or a signal out. And I think I found the one we're going to put out there. What do you guys all think about that? What do you think about the reward to risk on something like that? Ricardo, I think unfortunately you are a little late. The wheel is closed. All right, folks. As soon as we finish with market minds here, get back into the rooms. I will be for certain looking at a potential setup in SBET. All right. Here we go, guys. TGIF, market minds, spinning away. Valerie or Victor? Oh, Victor with an extra Cheerio. Victor, you still here? I know you just, you know, put something in the chat here just a minute ago. Come on, Victor. Oh, no, Victor. Where did Victor go, everybody? Victor, Victor. There he is. Yes. All right. Beautiful. Beautiful. Okay. Everybody have a fantastic weekend. I will be downtown in our offices on the floor on Monday for Market Minds in the S&P 500 pit. I wish everybody a fantastic weekend. Hope for a Cubs sweep over the Cardinals. We'll see you all on Monday.